Thank you very much for being here. And we are now ready to go with the Delaware Statutory Trust overview and also a 1031 exchange overview. Just to get started, I'll just mention a few risks and disclosures so that everybody's on the same page. DST properties are available for accredited investors. That's someone who has a net worth of over $1 million, not counting their primary residence. And what we're doing today is basically for education purposes only. We'll be talking about the private placement memorandum where we get all of our information on each property. And because it is a concept, a complex tax concept, you really should consult your legal and tax professionals about your own specifics in your situation. We can't give tax or legal advice. And anything that we talk about, you have to just remember that past performance is no indication of future performance. So there are risks in real estate, risks just like if you own your own property across the street. So we will then dig into the fact that everybody's situation is different. We believe this information that we're going to be talking about today is reliable, and no cash flows or returns or appreciations are guaranteed. So in a 1031 exchange, basically a 1031 exchange is a concept and a tax law where if you hold property for business or for trade or for investment, you can exchange it into another like kind property and not pay your taxes for a while. You get to kick the tax can down the road. And by doing that, it was a law that actually came into being about 100 years ago. So the 1031 exchange has been around for a long time. It did get a lot of attention this year when the government was talking, and is still continuing to talk about new tax laws, but so far the 1031 exchange is staying right where we want it to be, where everybody can use it for a tax deferral. The way a 1031 works is that you have to have a qualified intermediary, and that means when you go to closing on your property, you will want to make sure to have a third-party company called a qualified intermediary or an accommodator to hold your funds. You do not want to come out of your closing and have those those funds coming to you in any way, shape, or form. You can reinvest 100% of your proceeds into replacement properties, and then that would be a complete exchange. You can also do a partial exchange if you wanted to pull out some of your own dollars and keep them for the future. Then you could just not give it to the qualified intermediary, and you would be able to pay taxes on those funds and use it. If you do purchase a property of equal or greater value than the relinquished property, then you would be doing a complete exchange, and you would be, as I said, kicking the tax can down the road. There's some rules. You have to identify which replacement properties you might be thinking about buying within a 45-day time frame. So from the date of settlement, you have 45 days to decide which properties you might want to invest in. And there's a couple of rules that we will be talking about where you have a choice of how many properties you can identify. After you identify the properties, you actually have 180 days to go to settlement on those properties. And that 180-day period is really, it doesn't matter whether it's Christmas Day or a holiday or a weekend, the 45 days and the 180 days are chiseled in granite, and you really have to make those work. In the 45 days, when you get to that point, you are either going to identify 3 properties of any price, or you can identify up to 200% of your fair market value. So twice your sales price in any number of properties. There's a third way to identify as well. It's called the 95% rule. And in the 95% rule, you can identify any number of properties at any price, but you have to buy 95% of those properties. So we don't see that one used very often. Most people who are buying whole properties instead of the Delaware Statutory Trust properties that we'll be talking about will use that 3 property rule. because you can just sell something for $1 million and identify something for $1.5 million and for $1 million and maybe for $2 million. And in that 200% rule, in our world of DST investing, you would want to diversify. So you might identify, if it's the same $1 million exchange, you might be identifying 5 or 7 or even 10 different properties to choose from. So when I said like kind earlier, what I meant was that you don't have to sell an apartment building and buy an apartment building. You can sell an apartment building and buy an industrial building. You could sell raw land and buy farmland, or you could buy a distribution, a FedEx distribution building. So it doesn't have to be the same type of property as long as it's real estate. And a DST is a type of property, and so it does qualify for a 1031 exchange. A Delaware statutory trust is basically a property where you own an undivided interest in a larger institutional quality property. So you are looking at doing an exchange, and instead of perhaps just buying one property, you're now looking at buying multiple properties so that you have a nice diversification. We usually suggest that you diversify across asset class, across tenants, across geography, and even across the companies that put these properties together, so that you might have something like a distribution center, multifamily, perhaps a medical office, just different types of properties. And so people will use these DSTs, Delaware Statutory Trust properties, both for 1031 exchanges and also for cash investments. You don't have to be in a 1031 exchange to do it, but it is qualified to be a 1031 exchange property ever since 2004, with a revenue ruling by the IRS saying that DSTs will indeed work. So a DST is a way to hold title. You can hold title in companies or with companies like your LLC, your limited liability companies, or a trust that you might own, or you could own it, properties as a partnership. But if you have a partnership or an LLC that you want to buy into, those don't qualify as a 1031 exchange. So the DST does qualify, and that's very important to consider. When a DST is bought and you own it, what most people expect is that they would get a portion of the rents. So if you bought into a multifamily property with 200 or 300 units in it, then you would likely receive your percentage, your pro rata portion of the distributions from the property. Meaning, say you owned 5% of that building, you would get 5% of the net rents. When you hold the property until it sells, then you would receive 5% of the net proceeds after the sale. So a property could go up in value, it might go down in value. Hopefully, we are always hoping the properties go up in value, but something could happen where it didn't. So it's not like some syndications that you might see where there's a waterfall split or preferred return to the developer. In the DST, it's basically pro rata. If you owned the 5% or the 1% or the 10% of that property, then you would be getting that amount of the proceeds or of the monthly rents that come in. When a property is sold that's held as a DST, the investors are free to do another 1031 exchange. So you could roll back into another whole property if you wanted. You could pay taxes if you wanted, or you could buy another DST or another diversified portfolio of DSTs. Sometimes what happens is you would also be offered an option to go from the DST into a REIT, a real estate investment trust. And that's something that's really being looked at a lot lately, to have that option, because it would give you an undivided interest in many, many more properties. And so it's just another way to hold real estate. If you go from the DST into a REIT, however, that would be the end of your 1031 exchanging. Once you're in a REIT, should you decide to sell those properties or to sell your shares, then you would be paying taxes on that gain at that point. You wouldn't be able to go on. But if you rolled, you did your 1031 exchange into another DST or another whole property, then you can continue with the 1031 exchanges. And we often call that swap till you drop, meaning if you were to continue with 1031 exchanges until you happen to pass away while you held property, at least as the laws are right now, you would get a stepped up basis at your death, which means your heirs would not have to pay taxes because they are basically inheriting the property at today's value, and then they would sell it at today's value, so no gain would be realized. The reason I like DSTs is because of this, the management headaches. I'm lucky enough to have had properties throughout my career where I was the manager and taking care of tenants and toilets and trash. But at a certain time in our lives, we get to the point where we really don't want to do that anymore. And so I am at that point, and I looked into DSTs for that very reason, to have somebody else manage the properties that I own a piece of now. And it gives me time to do other things. Other investors will do things like kids and grandkids and travel and enjoy life without having to manage the property and make sure that things are being taken care of on your property. In a DST, typically the investment would be $100,000. Some are higher and some are lower, but typically it would be $100,000. And because of that, it gives you the opportunity to spread out your equity over many properties instead of just one. I mentioned earlier that you could spread out your dollars in multifamily, office, industrial, medical, triple net properties. A triple net property is a property where the tenant pays for the taxes, insurance, and maintenance. And you might think, well, that sounds easy to do. Maybe I don't need a manager to do that. But if we typically look at triple net properties, and that was my background before I got into the DST world, was as a triple net broker. But there's still a lot of things that you have to consider in that world. In a triple net investment, typically you're investing at least $1 million and often up to 5 or 10 million to own one Dunkin' Donuts or one Wendy's franchisee property. And if you are the owner, you have to make sure that the tenant is paying their taxes, the tenant is taking care of the property, the tenant is giving you the correct distribution. You might even in some cases have to pay the taxes and insurance and then get reimbursed from your tenants. So there's still a lot of things to be that you have to worry about if you do a triple net property. In the exchange, when you sell your property, you're going to basically replace your sales price. So over here on numbers 4 and 5, we're talking about all cash debt-free DSTs and also leveraged DSTs. So if you had a property that sold for $1 million and you owed $300,000 on it, you have $700,000 cash, and you have to use that $700,000 to replace your sales price, your $1 million sales price. So in a DST, you could put that extra $300,000 into a DST that has debt on it and take care of that. The other dollars could go into properties that have no debt on them, which just gives you a little bit more of a, well, it takes a layer of risk off the table if you don't have a loan on the property. I mentioned multiple geographic locations. A lot of us saw that in a big way during the pandemic when cities like New York basically shut down. And if you owned real estate in New York and your whole portfolio happened to be in New York City and it was New York City office, you were struggling right then if the tenants couldn't pay the rent. So it does make sense in some situations to diversify across different geography. At the end of the year, what happens? And it's actually fairly easy with a DST. So instead of going through all your receipts on your own and trying to put together your tax paperwork, what you get at the end of the year with a DST is not a K-1, but it is a 1099. It's called a substitute 1099 or a grantor's letter. And what you get from the asset manager is called a sponsor. What you get from them is the information that you would need to put on your Schedule E. So if you have rental properties right now, you may remember that it goes on the Schedule E. At the top, you put the 1099 number, which is the gross. And then the sponsor gives you all the line items that you need to be able to fill in that form, or your CPA can fill in that form. And the bottom line on that page gives you your net, what you actually receive during the year as rent. And the rents are paid monthly, so you actually get your rent monthly too. All right. The financing, I mentioned financing earlier, and one of the things that you have to worry about if you're doing a 1031 exchange is that you only have that 45 days to identify. And so if you are doing a DST, the loan is already in place. So you get rid of that aspect of trying to make sure you can have it all come together. The financing is typically non-recourse, which means that you don't have to sign personally for that loan. It doesn't really show up on your financial statement. You do get the benefit of the interest write-off, and it's just done. It's already done for you. So if something were to go terribly wrong with the property, the lender can't come looking for you the way they might if you owned your own property and try to go after some of your other properties to make up any shortfall. In a DST, the lender's only recourse would be to go back to that property itself. So if you get the loan, if you had to get a DST with a loan on it, or you chose to get a DST with a loan on it, you would have, in some cases, an amortizing loan. And so your principal pay down would be allocated to you. So if the loan started out at $50 million, and by the time they sold the property, it was down to $44 million, you would get your pro rata share of that principal pay down. And so typically the percentage of a DST on a loan would be between 50 and 60%, although there are some that are about 30% loan to value and some that go up to 86.75% loan to value. That's called a zero coupon property. And the zero coupon property is really used for investors who have a very high loan to value on their relinquished property. And so sometimes you would be in a situation where you owe more to the IRS than you would have coming out of the property that you own. A lot of people will put financing on a property over the years, and so they might be selling again for that $1 million or $10 million, whatever it is, but they owe $900,000 on their $1 million sale. So that means you're only getting $100,000 cash from the sale, but you might owe $300,000 in taxes. And if that happens, then you can talk to us at K Properties about the zero coupon option. That might be a good fit for you. So if you don't have to have a loan on the property, if your relinquished property didn't have a loan on it, or if you are just considering a cash investment in DSTs, the beauty of the all cash debt-free DST properties is you never have to worry about refinancing. You don't have to worry about taking on equal or greater debt in the future. And I'll explain what I mean by that one. When, let's say you had $1 million in cash from your sale, and you put that into leveraged property. So that meant $1 million down and $1 million equity. Equity and $1 million loan. So now you're buying $2 million worth of that property. If that were to be the case, the next time you go to do a 1031 exchange, you have to replace your sales price. So let's say it's sold for what you had in it. It's sold for $2 million. You can't go back to being debt free at that point. You have to now carry that debt with you for the rest of your 1031 career. So if you do just debt free ones, it just mitigates the risk a little bit. You don't have to worry about selling because your loan is due. There's no cross collateralization. There's no cash flow sweep, which is where in certain circumstances, the lender can hold your money for you. There's no debt service. So sometimes the cash flow is higher. Never have a lender foreclosure, never have balloon mortgages coming up. When it comes time to sell, you don't have to worry about prepayment penalties or defeasance costs. And typically often the debt-free DSTs will be lower fees. So how long does it take to close? If you did decide on a DST, you would typically be owning that property and your pro rata rent would be starting typically within 3 to 5 business days after you turn in your paperwork. And the reason for that is because the properties are already owned by the sponsor before I can offer you a piece of it. So you'll have access to the appraisals, the phase 1 environmentals, the building condition reports, the estoppels, financing, everything's already been done and prepackaged on a shelf. So you get to choose which properties you like and they're already ready for you. You don't have to go out and order all your own third-party reports to be able to get to that 45 days and then get to settlement very quickly. I've mentioned these so far, lots of different types of property, the government leased properties, the healthcare, triple net, multifamily, distribution centers, the zero coupon. As we get to know you, we'll start putting together a portfolio for you to get a good diversified sample so you can try to hit all the different aspects of your 1031 exchange and stay diversified. Qualified, we talked about the DSTs being available for accredited investors, and that's someone who has a net worth of greater than $1 million, not counting their home, or they could have income of $200,000 as an individual or $300,000 as a couple. And an accredited entity is an entity that has assets over $5 million. So I'll show you quickly just a few of the types of properties that are available. I've mentioned before, FedEx would be a distribution facility. Sometimes they have just very good demographics, maybe near an airline. So we'll look at each property individually. You can get multifamily, sometimes with debt, sometimes without. Pharmacies are a good type of DST properties that might be available, whether it's a Walgreens or a CVS. Frito-Lay, this is just another distribution center. This one was right near me in Washington, D.C., near Dulles Airport. FedEx is, again, I mentioned the medical. We see a lot of DaVita, Fresenius dialysis, maybe urgent care, or other types of medical. The plasma would be another type of medical, typically with a long-term lease, often with escalations during the primary hold. Data centers are in demand, but hard to come by. They're hard to find good data centers on the market. But we always like things like self-storage facilities, commerce, e-commerce. And what sets us apart here at K Properties is really our due diligence process. We have a team of due diligence just a team of our due diligence that is really remarkable. They are amazing. They have worked for other sponsors. They've worked for private equity firms, real estate companies, REITs, real estate investment trusts, international research firms. So what they do is they just look at everything you can look at. They mystery shop. We send someone to see every property that is on the market. Even if the portfolio, the DST portfolio, has 25 or more properties in it, we'll send someone to see each property. We look at the property inspections. We have commercial grade databases and subscriptions that we have that we really are going to try to compare to make sure the property is what they say it is. We look at the third-party reports, the zoning, the appraisals and everything. But we do something other people don't do. We start at the top, at the highest level, and say, there are certain asset classes right now that we're just not going to recommend. And some of those would be things like regional shopping malls or senior care, hotels, oil and gas, saltwater drilling, things like that. even student housing right now, we're not doing student housing. We just don't think it's the right time. And a lot of people are saying, well, senior care, things like assisted livings and dementia care. But right now we think there's just going to be a little too much um, government intervention, lawsuits, things like that, that are going to be happening after the pandemic. So for right now, we're just saying no to those asset classes. Again, I mentioned that we mystery shop every DST that we have on our platform. I love this line, because your due has not been done if your diligence isn't diligent. And we try to make sure that ours is. So we look at the properties not just as a physical property, but also how about the assumptions that the sponsor is using? Are they indeed looking at what could go wrong? Are there guesses on how much they think the property might raise the rents, or how much expenses might be? Do we feel that those are in line? And so our stress tests really help analyze the various scenarios and just to see if we think it might withstand the test of time. And it could still go wrong, but we want to try to do everything we can to make sure that know ahead of time the risks that are involved. And again, we can't identify all of them, but we can try. When we look at the lease, we know that the lease is so important. Sometimes a lease can have items in there where the tenant could give away their guarantee and let someone else be the guarantor, which means that it might not be as strong. We don't want that to happen. Or they could go dark, meaning they could move out for a certain reason, or they might have a right to lower their payment. Let's say it's a McDonald's in front of a Target. If the Target goes dark or moves out, then the McDonald's might have the right to lower their rent to see if their income is going to be hurt. Their gross income is going to be hurt because of the other person going dark. So we're going to look at those types of things. We're going to see what the tenant is responsible for, what the landlord's responsible for. And because we're real estate people, we kind of understand this more than some other people might do. If someone's not in real estate, they might not even understand that an offering is showing a leasehold instead of a ground lease. And what that means is you might just own the building and you don't even own the land under the building. And so that's why it's just so important to be talking to real estate people when you look at real estate wrapped in the DST wrapper. We look at the third-party reports. We just want to make sure that that we understand the market, we understand the property itself, and we understand the lease. So in summary, basically what we're going to try to do is reject the properties that we don't think should be on the market right now. We don't think it should be for our clients right now. Maybe if you were getting a huge return, it would be worth the risk, but typically those properties might only have 0.5% more return. And is that really worth the risk? And we just don't think so. And then what we do, we just keep looking at it until we find properties that we want on our platform. And even though we have them on our platform, we might have a property or two that has the name risk awareness on it, because we're not going to say that you can't invest in these, but we might say you can invest in this, but we still want you to be aware that we've identified some risks in this one. So make sure to ask us about them before you invest. We still let you invest in those, obviously, but we're going to put it on an email to you that we perhaps didn't encourage you to do that. So if you wanted to work with us, it's fairly easy to get started. And the initial way to do that is by giving us a call, sending us an email, letting us know of your interest. And then our first call comes together and we're going to be asking a lot of questions of you. We're not going to be telling so much. We're going to be asking to try to draw out from you things about your likes, your dislikes, your needs, needs for cash in the future, how close you are to retirement, your risk tolerance, all the things that we would need to be able to develop a preliminary recommendation for you, which was really just a starting point, because we want to be able to give to you a portfolio where this could be something that could work. It would be diversified across geography and tenant and asset class, and even the sponsor companies, as I mentioned. But it's a way to start. We're going to make sure that it fits into your debt needs so that you're replacing your sales price using the cash available. And from that initial point, we would then go to a kind of a secondary level where we are now digging around on that sample portfolio and really creating it to be more about you. So you might look at it and say, oh, I love this, but I would never buy in that state. I hate that state. You know, I used to live there and I just never liked it. So it could be that we're taking out some properties, putting in some properties. You might say you want more leverage than we might recommend. We can change those. We can add, subtract dollar amounts and the different properties that are available until we get really what you are going to be looking at. We do suggest at times that we put you in touch with a group call to the sponsor, who will then talk to us a little bit more about their offering, and we can set up property tours if you wanted to go to see it. We'd love to have you come meet with us. We have offices in New York, Washington, D.C., San Diego, San Francisco, Seattle, Boston, Dallas, Los Angeles is our headquarters. And what happens is you're going to be working with a team. So I'm a senior vice president. You'll also be working with a vice president. In many cases, we'll have another associate on our team, and you have your own transaction coordinator who we all just hold your hand. We really want to give white glove service so that you are having the information you need when you need it, and someone always available to you so that you can get your questions answered very quickly. And we coordinate with that qualified intermediary and as well as the sponsor companies to get that, to get your property settled in very quickly, hopefully. After you invest, we're still here. We want you to come to us for information. We want you to come to us to ask questions. The sponsor, when you go to settlement, will send you their information on how to contact them, and you're welcome to call them every time you want, but we are also here. If you have questions, we can put you in touch with the right people, because we really want you to work with us for years to come and know that we are a resource for you. And also when your property sells, we'd like to tell you what else is on the market. And people do pick us for various reasons. One of them is that we just do the real estate properties. Other financial planning firms, and I like the fact that some people have a good financial planner on their team, but sometimes the financial planner is a generalist because they're going to be, well, they were specialists in their field. They're going to perhaps advise you on insurance, stocks, bonds, mutual funds, puts, calls, annuities, all those other things that we just don't do. We focus on real estate. So it's, as it says here, it's like going to a general practice doctor if you need a specialty operation. If you need real estate, we're going to be the ones to help you with that. We are licensed in all 50 states. I mentioned the different offices that we've had. We have over 150 years of experience and $30 billion of DSTs that we've worked on. So we're just a phone call away for someone to start the process. And as I mentioned, we're picky with our properties. We have properties that are on the market, meaning they are out there from a lot of the sponsors, but we also have properties that are exclusive to just K properties. So what that means is we're going to have properties, especially debt-free properties, that we're the only ones who have these properties. And the reason for that is we like for you to not have to pile on debt if you don't need it. If you want it, fine, we can help you do that. But if you don't need it, then the debt-free properties are, we try to find everyone that we can, put it through our due diligence process, and then add it to our list. And other sponsors, other folks don't work as hard to get the debt-free ones as we do. So we don't sell those other assets. I guess if you did want to buy oil and gas, hotels, or senior care, or even student housing right now, you'd have to find somebody else, because we're just not offering those right now. It just doesn't seem like the right time to be in those asset classes. And on our website at any given time, there might be between 15 and 30 different offerings that you can see, probably from 20 to 25 different sponsor companies. So we have a large inventory of properties for you to consider as you are looking at your options with the DST. I mentioned that we do mystery shop. You can see those reports as you go through, so you can pick apart a property to tell which one you might want on your portfolio. And I mentioned again about the loans to value. When you have to replace your sales price and you have to use up all your cash, there often is a shortfall in there between the properties that you have, or the dollars that you have, and the amount you have to buy. And that's where having DSTs with the loan already in place is so important. And the debt-free ones, again, we can discuss which ones might be best for you, and you can get with our team. So I like the fact that we do invest too. So the reason I got into DSTs was actually one of my clients in the triple net world asked me about, couldn't she just invest in a piece of property, because she had about $1 million and couldn't find anything in that price range. Typically something like a Dollar General with not very many years left on it might be $1 million. Typically they're more than that. And she asked me about this. So I went looking and found the DSTs back in 2016 when I kind of came over to this world. And she had already finished her 45 days, so didn't get into a DST. But I looked at it for myself and thought, even though I've been selling triple net properties for years, CBSs and Red Lobsters and all those kinds of properties, I never bought one because I just couldn't bring myself to put $2 or $3 million into any one property. So when I found the DSTs, I thought, wow, I can sell off my rentals and actually buy a little bit of self-storage, a little bit of multifamily, a little bit of medical, and make a portfolio for myself that would really make sense for me and for my family. So we at K Properties, again, don't just offer these properties, we walk the walk. We buy the DSTs ourselves. So we are specialists. We are everywhere in the country. We're probably the largest rep group. We're called registered reps in this world. We're probably the largest rep group in the industry. Again, our real estate expertise, over 150 years of it, and $30 billion worth of securitized offerings that we have done over the years. And we do have client references. We have CPAs, attorneys, qualified intermediaries, and even financial planners who recommend to their clients that they work with us because of our emphasis on education and doing what's right for the client. So if you thought you might be interested, it's really no pressure to take advantage of talking to one of us and learning about DSTs, learning about 1031 exchanges, and see if it might be a good fit for you. If it's not a good fit for you, then that's fine. It's still a good education for you and good for you to know about this subject. So we're always here, weekends and holidays, whenever you need us, which is one of the reasons we like the team approach. Because you know that if I happen to be out playing pickleball or something, you could catch my my colleague, my partner on it. So when I came off my career in single tenant net lease sales, I was on a big high because I did well in that industry. And so I went out looking for which firm I wanted to be with to offer DSTs. And it was really kind of amazing because across the from two different friends in the business, both of them pointed me to Dwight K. One was a sponsor and one was a one was kind of with an advisory firm. And both of them said, based on me and my attention to detail and my focus on education and doing what's right for the client, both of them said, you need to talk to Dwight K. And when I went with Dwight K, I really realized I used to have my own commercial real estate firm. So I know I didn't want to be the one in charge of phone systems and secretaries and advertising or anything. I wanted a team. I wanted to have somebody. So with K Properties, we have CPAs on staff. We have attorneys on staff. We have marketing and follow-up and client interaction. We have the people we need to be able to help our clients get what they need whenever they need it. So because of this, I just really think Dwight K's company, K Properties, is just a good place to land. DSTs are getting more and more popular. You've probably seen us in various articles, Mid-Atlantic Real Estate Journal. We've had articles in there along with Forbes, New York Times, other places. So it's becoming more and more commonplace. And K Properties is often quoted as an expert in the field. And we did talk about the risks. So if you do have any questions, check with your own CPA and attorney to make sure that DSTs are right for you. But we will be happy to also walk you through and help you with getting to see if a DST might, or a 1031 exchange might be the right way to go. So I'll stop there, and Ron, see if you have any questions.
Okay, well, thank you, Betty, for a very detailed and informative discussion about DSTs. This is the time where we turn to our audience to see if they have any questions for Betty. And I will remind the audience that you can pose your question either through the chat box or through the Q&A. I will monitor both. And as you're thinking about questions to ask Betty, let me start with the first question off the bat. And Betty, over the last 2 years, we have been involved in a major pandemic, to say the least. I'm just wondering, how has your business changed, if at all, pre-pandemic to now being right in the middle of one?
Yeah, that pandemic has certainly changed the way a lot of people are doing business. And I think, on the macro versus the micro scale, in real estate itself, certain asset classes are a little more challenged right now. And I mentioned a few, like student housing and hotels, and also office buildings are more challenged. And so income over the pandemic could actually have gone down on some of the properties. So when we're looking to help you design a portfolio, we might talk to you about there's kind of two types of properties, and one, we'll call it an anchor and a buoy. So properties like the triple net properties might give you that predictable, durable income, and properties like multifamily or self-storage or short-term industrial, they might go up and down a little bit during the pandemic, during a recession, during things that might happen in our economy. So if you were to have a balanced portfolio with some giving you predictable, durable income and some giving you the up and down income that might be able to track inflation a little bit better, if we get inflation, which it looks like we might be, interest rates might be going up. So it's really made it come to the forefront more about the fact that there's two kinds of properties. One might go up and down, but track inflation. The other might give you more predictable income. On a personal level, we're seeing a lot more people work from home and a lot more people not wanting to travel as much. So I think everybody's seeing the results of that. And it used to be we would travel more with our business, but that has slowed down a little bit too. But I think it's picking back up now that a lot of people are vaccinated.
Okay, we have two similar questions from two audience members, and probably a question that you would normally expect to get in a program like this. And the question very simply is, how does K make money in this entire process?
Okay, that is a great question. And if I were still a real estate agent, which I do have my license hanging, but I've been in real estate since '79, so it's just over there. But if I were your real estate agent and you wanted to buy a new home from a builder, I would take you around to each of the builders in your area. Around here, it's things like Ryan and Ryland and Pulte and Richmond American. I would take you to each builder and I would help you decide if that builder might be a good fit for you, talking about their strengths, their weaknesses, what they, the areas and all. And when you bought that house for $500,000, you know that that $500,000 includes the cost of the land, the cost of the sticks and the bricks, the construction workers, the permits, the architects, the engineering, the back office, the model home sales office, their rep, and also the realtor fee. So it's all included in the one fee. In this world, I'm kind of like that in that I'm going to take you to all the different sponsors that have properties that you might consider. I'm going to help you analyze those through our due diligence and other ways that we're going to be talking about. And once you decide on the properties that you want, let's say you invested $100,000. That $100,000 includes the sticks and the bricks and all the pieces of the puzzle and the expenses, and it includes my fee as well. So it's all included. If that $100,000 were to get a 5% return or something for the year, we would multiply that 100,000 times 5% and divide it by 12. And as long as the tenant paid rent, that would be your rent too. All those fees are actually in what we call the PPM. And the PPM is a private placement memorandum. And as we're looking through properties together, we can get on a Zoom call, or you can have the PPM open in front of you, and we'll actually look at the PPM and be talking about the fees. It's all very transparent. There's just a list of them on a page called the use of proceeds. And through that use of proceeds, you'll see where all the dollars go. And so I earn a commission, just a one-time commission, just like real estate.
Rich in our audience has asked, can you contribute a single tenant property to a DST?
You might be able to sell your single tenant property to a sponsor who just buys it from you, and they might have a DST to offer you. But typically you can't do that. It would be two separate transactions. So if you, let's say you had an auto zone, that same sponsor may want to buy it from you, and just on a separate transaction, they would buy it from you, and then you could do a 1031 exchange into their DST. But I think it would have to be separate.
You mentioned in your comments at the early part of the presentation that there were some concerns that the government may be changing certain laws that might affect your business. Can you expand on what possibilities or what concerns you might have with respect to specific legislation that could either be a positive or a negative to your business?
Yeah, a lot of our business comes, I can track our business based on what the qualified intermediaries are doing. So they think it's still going to be continuing to be a pretty robust market for right now. But this past year, there was a lot of talk about the 1031 exchange going away. And as I mentioned early on, it's been around for 100 years, the 1031 exchange has. It started out when farmers were trying to just trade land to true up their square. Basically, someone owned some land over here, they would just trade it, and it evolved into what we now call the starker, the delayed exchange. The government was thinking of, at first, maybe doing away with it altogether. Second, maybe just limiting it to a dollar amount of people over a certain income level or a price point on the sale of property, where over a certain price point that you might not be able to do a complete exchange. So far, it's not in the bill that's moving through the system. So I think that it's not going to be on this one. I'm going to knock on wood, because I guess they could still do something and put it in there. But for right now, it's not one that's being looked at anymore currently. There's another piece of the puzzle, and that's the stepped up basis, a step up in basis on property. And what that means is if you happen to die while you own certain asset classes like real estate, your heirs inherit it at today's value. So again, if they sell it at today's value, there's no gain because they inherited it at 300,000 and they sell it at 300,000. There's talk about changing that as well, but so far it's not on the current, as far as I know, it's not on the current table as a discussion.
Another question from our audience refers to the comment you made about receiving a portion of the rents. Our audience member wants to know, were you referring to the gross rents, or were you referring to the net rents, i.e. rent after expenses?
Rent after expenses.
Okay.
So just like in a regular rental, if you were thinking about how much you really made in a year, you would look at your Schedule E that we talked about, and you'd actually take out the depreciation line, and that would be your gross at the top, all your expenses, and then your net at the bottom. And if you divided it by 12, that would give you approximately what your monthly rent would be. And it's the same in the DST. They do the gross rents, take out the expenses, and then give you your net at the end.
Next question is, are properties that might be considered value adds part of your program?
Yeah, that's a really good question. So some properties are like those anchor and buoy. Some of them are the anchors that probably not much value add to a FedEx distribution center or an Amazon distribution center. Those are ones that are just, they are what they are. Amazon guarantees the lease. They don't have to raise it anything other than what's in the lease. The DST rules allow for light value add, not a, you couldn't build a new building or, do some really big value add. But a lot of times in something like a self-storage or a multifamily or a short-term industrial, you'll see that they have a program, and it's in the business plan that is in the PPM. That sounds confusing. In the private placement memorandum, they'll have a business plan. And in that business plan, they might say they are intending to take 100 of the 300 units and redo the interiors. And maybe it costs $7,000 or $8,000 per unit. But that's something that could be allowed within the system. And by putting in that $7,000 or $8,000, they might be able to raise the rents $150. So that's a pretty good return on your investment. And so that would be a part of the properties that you might be interested in. And again, each one is in that wonderful book that we call the PPM, because we see in that how long they think they're going to hold the property, what the business plan is there any value add, is there any way to push rents? It's just a wealth of information right there in the PPM. So as we're looking at properties, we spend a lot of time there.
We have another question about depreciation.
Okay.
Can you talk about investors getting their so-called pro rata share of depreciation?
Mm-hmm. So I'm not a CPA or an attorney, so I can't give tax or legal advice. So ask your CPA about this. But what I've heard a 1031 typically works is that if you do a 1031 exchange, no matter what property you're buying, whether it's a whole property or a DST, your depreciation schedule stays with you from your last property and goes into this property. So what happens is it doesn't matter, the sponsor's not going to give you depreciation. All they're going to do is say the value of the land is 85. I mean, the value of the building is 85%. The value of the land is 15%. And then you'll apply that to your own depreciation schedule. So it's not different from DSTs. It's just a 1031 rule.
With respect to pricing, which is always a huge issue in the real estate business, have you seen buyers and sellers' price expectations move a little bit closer or more divergent as from, let's say, 2 years ago before COVID and now 2 years later?
I think everybody's seeing that the market is just steamy hot still. There's still multiple offers on almost any asset class, except for probably office, and office is coming back actually from what I've been reading, but the market is still hot. And with the 45 days in your 1031 exchange, it's kind of difficult. If you sell, you're going to be getting the highest price that you can get. That means you have 45 days. You're going to be buying something at a high price. If you wait till the market tanks, you sell at a low price and you buy, you get a really good deal, but you sold at a lower price. Because that 45 days, it'd be wonderful if you could buy up here and then wait a year or two until the market slows down and then buy, but you can't. So you're getting in and out of the market at the same basic price.
Okay, I'm just noticing that we're literally just running out of time. So Betty, let me ask you for any final comments that you would like to provide to our audience today.
Well, I would love to invite everybody to come to KPI1031.com or give us a call. Oh my goodness, we don't have my phone number on there. So, oh geez, I can't remember the main office phone number. So my phone number is 540-613-1002. So you can sign up at our website to get access to our inventory. And we do have other webinars available and white papers and every kind of information that you could imagine at our website. So we'd love to talk to you.
All right. Thank you, Betty, for a fantastic presentation. I want to thank
you.
the audience as well for spending some time with us on this very important and strategic topic. And as Leah mentioned in the beginning of our presentation, if any of our audience members has some thoughts about us allowing us to project and to develop their business, we are more than happy to speak to you about those possibilities. Again, I want to thank Betty and her firm for being today's sponsor. If any of the audience members has any ideas for a future program, please feel free to email them to either the Mid-Atlantic Real Estate Journal or myself. We'll see what we can do in terms of putting a proper program together in the future. And with that, I'll turn it back to Leah with any final comments that Leah may have.
I just want to say, of course, thank you, Betty, and thank you to K Properties and Investments. And to the attendees, if we didn't get to answer your question, you can email it over to me and I can connect you with Betty so maybe you guys could talk, chat offline. And that is it. Thank you guys so much for taking the time today, and we will see you in the next webinar.
Okay, thank you, everybody, and thank you, Betty.
Thank you.
Bye-bye.